Real estate represents a significant asset class within diversified portfolios and possesses unique characteristics that distinguish it from equities and fixed-income securities. Forecasting real estate returns requires an understanding of property cash flows, economic growth, inflation, financing conditions, and property market cycles. Unlike publicly traded securities, real estate investments often involve illiquidity, significant transaction costs, and valuation challenges. Property values are frequently estimated through appraisals rather than continuous market pricing, which can create lagged and smoothed return measurements. Consequently, analysts must look beyond reported historical returns and evaluate the underlying economic drivers of property performance when developing long-term capital market expectations. A key determinant of real estate performance is its relationship with the business cycle. Property markets tend to experience cyclical movements that both influence and reflect broader economic activity. During economic expansions, rising demand for commercial and residential space increases property values and lease rates, encouraging new construction and investment activity. In contrast, economic slowdowns reduce demand, resulting in overcapacity, declining occupancy rates, and falling property prices. Because real estate supply adjusts slowly, imbalances between supply and demand can persist for extended periods. Understanding the interaction between economic growth, occupancy conditions, and construction activity is therefore essential when forecasting future real estate returns and identifying potential investment opportunities. One of the most important valuation metrics in real estate analysis is the capitalization rate, commonly referred to as the cap rate. The cap rate is calculated by dividing a property's net operating income by its market value and serves as a measure of earnings yield. Conceptually, it resembles the discount rate minus expected growth rate framework used in equity valuation models. During stable economic conditions, long-run growth in net operating income tends to approximate nominal GDP growth because rental income is influenced by both real economic expansion and inflation. As a result, cap rates provide investors with valuable insight into expected returns and property valuation levels. Cap rates are highly sensitive to changes in interest rates, credit conditions, vacancy rates, and competitive pressures. Rising interest rates generally increase required returns, causing cap rates to rise and property values to decline. Similarly, higher vacancy rates reduce expected cash flows and increase perceived risk, contributing to higher cap rates. Conversely, abundant credit availability and strong investor demand tend to compress cap rates and support property valuations. Structural shifts within industries can also affect cap rates significantly. For example, changes in consumer behavior and the growth of e-commerce have altered demand patterns for retail properties, leading to widening valuation differences between high-quality and lower-quality real estate assets. Real estate investors must also consider several risk premiums when forecasting expected returns. These premiums compensate investors for bearing risks associated with long-term ownership, tenant default, lease volatility, property value fluctuations, and liquidity constraints. Real estate typically offers a higher overall risk premium than corporate bonds because of its operational and valuation uncertainties, but a lower premium than common equities. Liquidity risk is particularly important because many properties cannot be sold quickly without affecting transaction prices. Publicly traded real estate securities, such as REITs, reduce some liquidity concerns, but they remain exposed to economic, financial, and property market risks that influence long-term expected returns. Exchange rate forecasting is another critical element of capital market expectations, particularly for globally diversified investors. Currency movements affect the returns earned on international investments and influence the competitiveness of economies and corporations. Exchange rates are driven by multiple factors, including inflation differentials, interest rate differentials, economic growth, trade balances, capital flows, and government policy actions. Because currencies are influenced by both macroeconomic fundamentals and market sentiment, forecasting exchange rates remains one of the most challenging areas of financial analysis. Nevertheless, understanding the major drivers of currency valuation helps investors manage international portfolio risk more effectively. One widely used framework for exchange rate forecasting is purchasing power parity, PPP. PPP suggests that exchange rates should adjust over time to reflect differences in inflation between countries. If one country experiences higher inflation than another, its currency is expected to depreciate to maintain relative purchasing power. Inflation differentials therefore provide an important starting point for long-term currency forecasts. However, exchange rates often deviate from PPP predictions over shorter periods because capital flows, investor expectations, interest rate changes, and policy decisions exert significant influence. Consequently, analysts typically combine PPP with other economic and financial indicators when developing currency forecasts. In addition to inflation, exchange rates are affected by portfolio balance considerations, economic growth prospects, and international capital movements. Strong economic growth may attract investment flows, but it can also increase a country's share of global capital markets, requiring additional foreign participation and potentially influencing currency valuations. Current account deficits, foreign direct investment, home country bias among investors, and reserve currency status all shape exchange rate dynamics. Analysts therefore evaluate a broad set of macroeconomic variables when forecasting currency movements. Effective exchange rate forecasting integrates economic fundamentals, financial market conditions, and global capital flow trends to support international asset allocation decisions and enhance portfolio risk management.